The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Global markets finding firmer footing. Live from Studio 2 here at Bloomberg headquarters in New York. I'm Romaine Boston.
And I'm Alex Steele. Reversal Wednesday?
No.
No, that's not what we're doing. We're not doing that.
Let me think about it.
We're going to get a little better here. Okay, well, the stock market is getting a little bit better here. So we have a rally in the equity market. You got the S&P up over 1%. The cyclicals leading the way, like materials. Also, autos really crushing it as well, up over 2%. Ford, GM really leading the way as well. On the downside, though, crude cannot seem to get a bid. The lowest level that we've seen in about 3 years, really weighing on the stocks as well. And the 2-year yield, which I was looking at because that's where we're going to get sensitivity to the Fed, Romaine, pretty much flat after a little bit of buying earlier in the day.
It's interesting to see the price action in equities right now, as it does appear they are going to hold their gains into the close, borrowing some big shock over the next hour. Remember, earlier in the session, stocks were oscillating between gains and losses because of concerns about those tariffs. But they found firmer footing upward midday, this after the Trump administration did indeed grant some tariff exemptions, including a 1-month reprieve for automakers. Take a listen to Commerce Secretary Howard Lutnick, who spoke earlier on Bloomberg TV.
The president is listening to the offers from Mexico and Canada. He's thinking about trying to do something in the middle. He's thinking about it. We're talking about it.
All right, well, whether that's going to be enough to erase all of the damage of those policy proposals that have erased, well, all of those post-election market gains, that remains to be seen. While market breadth is better today, it's still skewed toward defensive pockets like materials, like industrials. Materials, which yesterday did test the bottom of their trading range, got a boost today because of Trump's remarks about 25% tariffs on copper, steel, and aluminum. Meanwhile, industrials are being led higher by defense contractors, including Huntington Ingalls, after Trump apparently is said to be preparing an executive order to bolster U.S. shipbuilders. So that could be a positive. In fact, some analysts out there, including over at Citigroup, are urging investors to buy U.S. defense industry stocks as a market defensive play, saying that even with congressional chatter about military spending cuts, the world is no less a dangerous of a place, and that should keep defense budgets whole.
And that really leads to the volatility, right? There's some good, there's some bad to everything that comes out in terms of the headlines. And this just shows the whippy action that we've seen. This is one-day price moves for the S&P going back to about 6 months. This is 1% to the upside. This is 1% to the downside. And I want to draw your attention to just this year alone. We've had 12 out of the 41 trading days so far in 2025 moving 1%. This is a pretty dramatic move than what we've seen, say, for the last year or so. And the question becomes two things. One, does that continue? You take a look at Friday's jobs number, for example. We're looking at a 1.3% move, Romaine, to the up or downside via the options market. And that will be the biggest move we've seen since March of 2023. And where's the money going? Is it going into other areas of the market, or is it going to Europe, or is it going to other asset classes?
All right, well, let's pose that question to our first guest. Kicking us off to the close today is Jim Caron, CIO of the Portfolio Solutions Group at Morgan Stanley Investment Management. And Jim, I do want to kind of talk about this rotation of money, because at least within the markets here in the U.S., it does appear there's a sort of defensive nature to some of the rebound we're seeing. And as Alex was kind of alluding there at the end, there's also some money that's actually kind of moving outside the U.S., maybe because the multiples are just a little bit more favorable.
Well, that's the thing. I mean, I think the movement outside the U.S., particularly in Europe, is actually not such a bad move. I mean, that's something that we started to do in January and also moved to overweight Europe in February. Now, part of the reason here is that, when we think about returns right now, European equities are up anywhere from 12 to 15% year to date, way better than what's going on in the U.S. I know there's a lot of concerns over Trump and tariffs, but my contention was from the start of the year that Trump is a positive for Europe, not a negative, because he's a change agent. Look at what took place. We had over the past, I'd say, 48 hours or so, the European, the Germans and the European countries have found about $1 trillion of fiscal stimulus between infrastructure and defense spending. Mm-hmm. This is a major boost. This is more money than Germany spent even when the Berlin Wall came down, right? Yeah. So this, to put this up into context, this is really big. So I think what people are doing in the U.S. is they're looking at what was known as the Mag 7, And they're saying that's large cap tech, there's vulnerability there. I need to move to large cap value. One of the best large cap value segments of the market in the world is Europe. It's a large cap value market. And I think just for diversification purposes, the euro is also increasing in value, which also is a kicker to returns. There's a lot of reasons to diversify.
And we just heard from the French President Emmanuel Macron talking about that there is a way to sort of increase that spending on defense without actually raising taxes on the people. The flip side of that, though, of course, is the tariff threat still sort of looms for anyone who's up against the U.S. and Trump, and that includes Europe as well. And we haven't really even gotten to that stage. We're kind of focused right now on Canada and Mexico, but there's obviously still beef between the U.S. and Europe that has to be settled.
Yeah, absolutely. So look, I mean, tariffs are just going to be a feature of the system. We all know what's hagpening here. Tariffs, the way I think about tariffs and taxes, think of it as like a long-short trade, right? Tariffs are the short. Tariffs basically invite stagflationary in a stagflationary environment, which is a valuation killer. Effectively, what it does is it raises prices and it lowers growth, right? So you get stagflation. But on the flip side of that, the other part of the policy is also taxes. And this is what Trump is trying to talk about in terms of his policies going forward. If he gets some tax reform going through, which isn't really factored in many of the earnings estimates right now in the U.S., that's the long, right? That's the positive. But we've done the short part first, and all the bad news is coming out now. The long is going to sort of start to drip out over the next couple of months.
Well, right. So how long is that gap? Because that's going to dictate what you do with those trades.
Yeah, so I call this fiscal basis risk. I'm coining that phrase myself right now, right here on Bloomberg. So I call it fiscal basis risk because you basically have these two elements here. And the problem is we don't know how big these tariffs are going to be. This changes every day, it seems, right? And on the other side, we don't know what tax policy is going to look like. We know what we'd like or what Trump would like it to look like, but ultimately you need a bipartisan decision on this, right? So there are a lot of unknowns, and this is what the market's battling with right now. So we're going through a soft patch. The market is, VIX index is 22. It's risen. It's not at extreme levels. It's risen. And this is creating a need for higher risk premium. So therefore, you're getting lower equity prices. And the question you have to ask yourself is this just a soft patch or is this the start of something bigger?
Right.
And that's what we're debating right now. Where we come down on this is that this is just a soft patch. So we are looking to sharpen our pencil a little bit and go shopping on sale for the broader equal weighted parts of the S&P 500, which is doing much, much better than the market cap weighted.
So what does that mean specifically? Does it mean not big tech? Does it mean the cyclicals?
Yeah, effectively, by default, it means less big tech, right? Because if we look at the market cap weighted S&P 500, we know like 30% of that index is driven by these 7 stocks. If you go to the equal weighted, if you think about the other 493, effectively what you're getting is by default, you will be underweight that large cap tech. I'm not saying go short. All I'm saying is that the marginal dollar I'm getting today from clients, I am investing in the broader segments of the market. I'm not putting it into large cap tech. Everybody's overweight large cap tech because that's what's happened over the past 10 years. Everybody has a very big overweight. That needs to be rebalanced. So the marginal money is going into other places. And that's why you see a drag on the S&P 500 because of the dominance of that large cap tech, which is starting to come down in value.
Are economic conditions going to support that type of rotation, though?
So that's the key, right? So effectively, if you have a reasonable economy, now I'm going to say 1.5% to 2% GDP growth. Now consensus was a little bit above 2%. Probably have to dial that back down a little bit. First quarter is going to be a little bit rough. So what I would argue is that as long as we chug along maybe at potential growth or maybe slightly under potential growth, I think that the mid-cap sectors of the markets actually get the biggest benefit from deregulation and all of these other things. And this is where the boost should actually come. Mm-hmm.
All right, Jim, got to leave it there. Great conversation. Jim Caron, CIO of the Portfolio Solutions Group at Morgan Stanley Investment Management, as stocks across the board now hitting session highs here on this Wednesday afternoon. A deeper dive into the impact of those tariffs and the impact, of course, of those delays. We're going to talk about the already stressed out sector, the restaurant industry, and we're going to talk to a person whose M&A strategy was successful at Tony Roma's. She's become CEO. Mina Hall going to be joining us later in the show.
Plus, the restaurant conversation continues with the co-founder of major food group with trendy names like Carbone, Dirty French, and Hyzy under its umbrella. The co-founder, gives us his temperature read on the sector.
All right, and from savoring food to savoring life, a discussion on advancing the U.S. retirement system. Ed Murphy, the CEO of Empower, He'll be joining the program a little bit later as well. A lot coming up here on the big program. Stick with us. This is The Close on Bloomberg.
I don't know where tariffs go yet. I think you and I were talking about it earlier. I think it's early innings in terms of what the impact will be. The only area where I see tariffs impacting sort of AI infrastructure is really in and around specialized componentry.
That was Digital Bridge CEO Mark Ganzi talking to me earlier at the Bloomberg Invest about how tariffs are impacting the AI space and where specifically there'll be some issues. Let's get another perspective on this from another industry. Rob Holmes, president and CEO of Texas Capital, a bank that manages about $31.6 billion in total assets, has a really good read on the economy and the Texas economy as well. Rob, good to see you.
Thank you. Thanks for having me.
So what are your clients saying right now, in particular about tariffs?
Well, we did a business survey here recently of about 1,000 CEOs and business leaders, and we have there was Texas, admittedly, but we had about 50% be very optimistic about the national economy, about 80% be very optimistic about the Texas economy, and about 70% suggest that their revenues would grow this year. So I think in spite of tariffs, people tend to be somewhat optimistic.
Are you addressing your loan book at all based on the potential of tariffs?
For sure. Tariffs, we didn't start talking about tariffs this week or last week. We started looking at our loan book last summer and doing different playbook scenarios on what if tariffs came, what would effect be on the bank and our clients. And I think it's a little bit of an art, not a science. We feel like our clients will be fine. They will certainly feel it. Texas will feel it. Texas has 23 seaports, 12 deep water ports. We have the largest deep water port by tonnage in Houston, and the largest port in the country at Laredo. And when you have 10% of U.S. manufactured goods out of Texas and 10% of the country's GDP, you're certainly going to feel it.
How do any of the policies, though, particularly some of the efforts by the administration to reshore or at least nearshore some of the things that we are, at least right now, relying on from overseas, would that have a net impact, a net positive impact on Texas?
I think, of course. In the long term, absolutely it will, given our border and the amount of trade we have with the border. But that's going to be quite a while, right? I mean, right now, clients are looking for different alternatives to manufacture, different alternatives of pricing. The tariffs are very complicated. So if you're a department store and you're importing a table and it has steel legs and it's a certain type of steel, well, you may replace that steel for that table and still import the table. So these tariffs at the macro level are easy to talk about. But when you get down to the details, it's very complex.
What are folks, when they're expressing worries about that, are the worries primarily from the potential inflationary impact of the tariffs, or is it more kind of on the potential drag, I should say, on revenue?
I think it's both. I think it's margin. Now remember, tariffs. When Trump did this the first time, what the lesson learned was it took a long time to feel it and have them implemented, right? The second thing when people talk about tariffs, to the general consumer, they think, oh no, it's 25% on the retail price. This is 25% on cost of goods sold. So that's important to remember as well. But I think that our clients are concerned about margin. They're concerned about the effect on the consumer. Last month, the consumer spending was down, a four-year low. And I don't think that can be explained away by weather and natural disasters like everybody else. I mean, look at the payroll today that came out.
So talk about that part of the business a little bit more, too. So we have the business side and then sort of the loan book side and deposit side and stuff like that. Are you noticing anything from your regular retail customers and how they're managing a potential inflationary environment?
Well, we're primarily a business bank, so we have very little retail, but we see retail, the effects of retail. We have a very large sales and trading desk with mortgage-backed securities. Ginnie Mae, you see delinquencies rising very high. That is generally the lower FICO scores. We have lender finance businesses out of our FIG group, and so those businesses are exposed to the consumer. And it's a bifurcated consumer, right? The higher end is doing just fine, and the lower end is not. And that's very typical after a period of great inflation. And those with assets do very well, and those that didn't were burdened. It's a depression tax.
We were thinking, the the street was thinking that this year was going to be like the resurgence of IPOs and M&A and everything was going to be great and looking towards the deregulation and looking towards potential lower taxes, et cetera. That's obviously a later 2025 or 2026 story. Do you think the capital markets are really open right now?
Well, it depends. Like the high yield market's pretty nascent. The term loan market's pretty good.
Okay.
Bank loans are tepid, and they have been for quite some time. If you look at the H8 data, they haven't been growing. If you're a bank and you're growing, and we are at a great clip, you're taking a share. And the clients we do have, they're financing. It's refinancing. It's not new capital for expansion, et cetera. And that's been going on for quite some time. That's not the tariff discussion.
I'm curious, more at the local level and at the Texas level, I should say. We've seen a lot of companies take renewed interest in Texas, primarily because of the promise of a more favorable, if you will, regulatory environment. So whether that's a reincorporating from Delaware or simply just moving physical operations, whether it's from California or elsewhere. Do you see that trend continuing?
Absolutely. I think you'll see more and more businesses incorporate in Texas from Delaware and elsewhere. Governor Abbott has said one of his goals is to make Texas the most attractive place to incorporate. There's been 2 Senate bills, I believe, this week that have benefits of protections for officers and directors and make it more friendly for businesses to be there, and also require shareholders to agitate to actually own $1 million in your stock. So there's a lot of benefits to being in Texas, in addition to low regulation, road tax, and a pro-growth attitude.
All right, Rob, appreciate the conversation. Always great insights out of you. Rob Holmes is the president and CEO of Texas Capital. Stick with us, a lot more coming up, including a discussion about those, tariffs. Canada taking a shot at the U.S. liquor industry to fight back against President Trump's tariffs. More on that in our top calls. This is The Close on Bloomberg. All right, time now for our top calls. Big movers on the back of analyst recommendations. And we start off today with Palantir, an upgrade to market perform. This over at William Blair, which sees positive developments ahead for the AI software company. He says Palantir's government contracts bode well for sequential revenue growth in the current quarter, and the company's rich AI pipeline can help offset any downside risk to valuation. The shares up 5% on the day. Next, TKO Group raised to buy from neutral over at Seaport. The analyst David Joyce citing an attractive entry point after we saw that pullback in the shares earlier. He goes on to say that TKO's assets exhibit recession resilience and expects live events at UFC and WWE to remain fairly priced. Those shares up about 4% on the day. And finally, Mosaic, an upgrade there to equal weight at Barclays. The price target kept at 27. The analyst making the call based primarily on valuation and says that he's still cautious on the broader fertilizer group due to tariff disputes, crop prices, and increased uncertainty from U.S. farmers. Mosaic getting a pretty healthy bid on the day, up about 5.5%. And those are some of our top calls. Tariffs, of course, remains a big story for the market, and it's certainly a big one for alcohol makers. Canada says it's pulling U.S. alcohol and beer from its shelves in response to those U.S. tariffs that are now in effect. But for now, Brown-Forman investors are raising a glass. That's after a profitable fiscal third quarter report, though its CEO did hint that tariffs could cause headwinds in the quarters up ahead. Nick Modi joins us right now, global co-head of consumer research at RBC Capital Markets. He's got a sector perform rating on the shares. All right, Nick, let's first start with the quarter that was. I mean, we did see some surprising strength in some of their key areas. And of course, for our viewers, I mean, probably their most well-known brand is Jack Daniels. We're talking, kind of the quintessential American liquor brands here. What sort of drove the outperformance in the most recent quarter?
Yeah, I mean, really, they got a lot of benefit from overseas. Their international markets did slightly better than expected. And also the U.S. did better, but that was largely due to shipment timing. So they were, shipping ahead of the holiday season, and I think that benefited them for the quarter. But it's likely to come out of the next quarter because the underlying demand has been quite weak in the U.S. market.
Well, this is what I am curious about, particularly because when it comes to the tariffs, we're talking about a company that gets half of its sales, I think more than half, from outside the U.S. So if we do start to see more retaliatory trade policies coming out of Canada, Mexico, or even Europe, how much of an impact to the bottom line is that going to have on Brown-Forman and the top line for that matter?
Yeah, it's a great question. I mean, there will be an impact. We just don't know how much because we don't know the magnitude and the direct impact. And then we also have to see the very discrete exposures geographically that Brown-Forman has to the markets that would do retaliatory tariffs as it relates to the EU. Canada, it's not a huge business for them. It's really a U.S. business. So I would say versus some other spirits companies, I think Brown-Forman's probably in a better spot. But the reality is this, is that their biggest market, which is the U.S. market, is under significant pressure. We think things are going to get worse before they get better. And I think that's going to keep pressure on Brown-Forman. And keep in mind, I mean, the stock is up strongly today, but it has underperformed significantly. It's down 60% over the last 1 year. And I think it was a heavily shorted stock going into the quarter. So a lot of what you're seeing right now is just a short squeeze.
Yeah, they were one of the first companies to start mentioning tariffs, not even on this last call, but the call before that. So break down the two parts, because one is tariff, which is a demand issue, right? And then also a weaker U.S. What about their supply? What about their input costs, et cetera? How are they managing any inflationary impact there?
Yeah, I mean, well, agave, so they also have a tequila business, right? So agave prices have come down dramatically. That will help them at some point in the future. But, you know, these are long cycle products, right? So it takes time to work through the inventory. Mm-hmm. So they're going to see a benefit at some point in the future. It's just not right now. What we're seeing is a lot of price pressure in the tequila market because demand has weakened dramatically. So that's on their tequila side. As it relates to the products that they would use in their bourbons and whiskeys, they're looking at some inflation. We think that it's not as big of an issue for them because they have a lot of options across the portfolio at higher price points that consumers seem to be migrating towards, like Old Forester, for example, or Woodford Reserve, mm-hmm. right? So there's some positive mixed elements in their portfolio that I think will help them offset inflation. But I think pricing power at the kind of mid and lower tier of the category, which is where Jack Daniel's sits, I think it's going to be much harder to get by.
Is it weird? I never thought that Jack Daniel's was lower tier. Nick, before I let you go real fast, in your space, what is the company that you feel can manage tariffs and demand slow down the best?
Yeah, so we like Primo Brands, which is a big water business. It's predominantly U.S. based. There's really no outside exposures. So they really have a very limited impact from tariffs. So that's been our top pick. It's up dramatically over the last 12 months, but we still think there's more upside. And then Monster Beverages, we think also has a lot of upside this year, and they're hedged on aluminum. Mm-hmm. So we really won't see them get impacted by the tariff situation in 2025.
Great point. All right, Nick, thanks a lot. Really appreciate Nick Modi over at RBC Capital Markets joining us there. All right, coming up, how consumer sentiment may be taking a hit from geopolitics and tariffs. We're going to break it down with Michael Zezas, head of U.S. public policy research at Morgan Stanley, looking at a pretty fierce rally here. The Nasdaq up by 1.4%. This is The Close on Bloomberg.
This is not a trade war. This is a drug war. We've got fentanyl still pouring into the country, and it's got to stop. So what's happened is they're showing us even more ways to try to stop the flow of fentanyl. And if they can stop the flow of fentanyl, the president is open-minded. There are going to be tariffs, let's be clear. But what he is thinking about is which sections of the market that can maybe he'll consider giving them relief until we get to, of course, April 2nd. But I don't want anybody to forget, April 2nd is the day that we announce our reciprocal tariffs around the world. And so April 2nd is coming, but this is about fentanyl this month.
Of course, tariff talk, the talk of the town, and the man right at the center of it there is the U.S. Secretary of Commerce, Howard Lutnick, speaking earlier here on Bloomberg Television. I'm Romaine Bostick. That's Alex Steele. This is The Close, 3:30 p.m. here in New York as we count you down to the bells.
And we saw one of those exceptions potentially roll out when it comes to autos, giving a 4-week relief. But here's the thing. If every industry advocates to get a carve-out, then are there actually blanket tariffs?
Yeah, I mean, because we've heard this, of course, from on the food side. We've heard this on the apparel side. Everybody's in Washington right now lobbying for their own exemption, which raises the question, does that blunt the impact of what Trump is trying to do with these tariffs in the first place?
Exactly. And my friends, my everyday friends, are now asking how long until I feel it in the supermarket, how long until I feel it when I go buy stuff. So that sentiment already feeding through. Well, joining us now with more is Michael Zezas, Managing Director and Head of U.S. Public Policy Research over at Morgan Stanley. Now, you guys just released a survey of 2,000 U.S. consumers that showed a drop in consumer sentiment, the first negative reading since June of 2024. Is that tariff related? Is that inflation related?
It's hard to know exactly. There's also some political underpinnings there. It tends to happen when administration kind of changes in political power, that there tends to be this kind of swap. Whichever party is in power, voters who identify themselves that way tend to become more confident, and the opposite is true for other party affiliations. So there's probably some of that noise in the data, and there's probably a little more of everything that you're saying mixed in. Really hard to disaggregate at this point.
If we go forward with this stop and start and the mushiness of what we're going to get from tariffs, what do you expect sentiment to actually look like?
Well, I think it's fair to say that investors are really confused, okay, and I think like corporations are probably quite confused. And if you look at like measures of trade policy uncertainty, economic uncertainty, they are, at least of trade policy uncertainty, at historic highs. So that should sort of interrupt at least confidence in terms of how people are making economic decisions. And the tariff policy path, I think there are like myriad plausible outcomes here, but the read-through is that they're going higher to some degree. And whether or not you agree with kind of the use of that tactic and the aims of the goals of the administration, there's some cost associated with that. And the cost is going to have market effects. In particular, the clearest market effect we think is that yields continue to move lower.
So as you, and we saw a little bit, got a little bit of a taste of that, and then today we're seeing a big drop in the dollar for a third straight day. But I am curious about how this affects the psyche, because to the point is, at the end of the day, even if we get an exemption, this is a temporary exemption. So there's still that uncertainty as to then what happens come April 2nd, and what happens comes May 1st, or whenever the next exemption is. And if you're a consumer watching this, all you're hearing is high prices are coming. Either I need to buy now, or maybe I should just save my money.
Yeah, well, it's again, whether or not that interruption in confidence sort of manifests in doing less now, or tariff goes up and you do less later, the read-through from our economists is that this, at least in the near term, hurts growth, right? And so there is some temporary inflation effect that comes along with it, but eventually weaker demand kind of pulls down that inflation. It means less growth, and that's what I think ultimately the market has to contend with over the next 12 months.
By about how much are we talking about? I mean, right now, I think economists, at least the ones surveyed by Bloomberg, on average, we're looking at about 2.3% GDP for the year. Pretty much everyone we've spoken to on this program over the past couple of weeks says that number has to come down.
Yeah, I mean, our economists had penciled in for this year 1.9%, moving to 1.3% next year. And that was premised on the idea that we're going to see tariff escalation on China, some less tariff escalation, but there would be some on Europe. And ultimately, we didn't have penciled in Canada tariffs and Mexico tariffs. And maybe after these exclusions, it effectively ends up in the same place. But I think from our perspective, that we're below that consensus number. And if tariffs go on even more than that path that we talked about, we're probably inclined to think more about downside risks.
Let's flip it for a second and talk about upside for potential industries. Romain talked about this earlier in the show about how Citi upgraded defense stocks to be defensive because of maybe more spending or privatizing the U.S. shipbuilding industry or getting it going, whichever one it was. What are areas that are in contention to get a lot of benefit right now? Yeah,
well, I think it's a fair point, right? There's the sort of macro distinctions, and then there are kind of some sectoral underpinnings. So a lot of this is about rewiring how the U.S. does commerce internationally, right? And so if there is this kind of long-term goal, and if the tariffs work towards this long-term goal of incentivizing investment in the U.S. and building more supply chains in the U.S. amongst our allies, well, whether or not that helps kind of top-line GDP in the short term is not necessarily the point for industries that are going to be the recipients of that demand. We're going to help to build some of these supply chains like capital goods, materials, others. Like there are some potential bright spots there. But then you look at like IT hardware, where they're going to have to be the ones making that investment. They're the ones who are going to face more margin pressure.
Right, especially then you have the CHIPS Act maybe going away when that was supposed to do in part what you're saying, right? Bring chip manufacturing home.
Yeah, so there was that potential offset from the government. I think ultimately those numbers were relatively small anyway. So I don't know how much that sort of was going to defray the cost ultimately. The point is there are higher costs than sort of what could be borne by the not what could be borne by the system, but there's going to be some kind of crimp on margins here to consider.
It does raise the question, though, as to what role Congress will play in this, because some of the things with tariffs, Trump obviously can sort of make those moves on his own without Congress signing off on it. But once we start getting to some of these other policies, such as rescinding the CHIPS Act or some of these budgetary proposals, you need the buy-in from Congress. You watched that speech last night. Yeah, this was a Congress not just only divided amongst Democrats and Republicans, but there were quite a few Republicans that at least made clear publicly after that speech that they weren't 100% on board with some of those things.
Yeah, well, the problem here is what is the tolerance amongst this relatively thin Republican majority for deficit expansion to accommodate some of these tax choices? And we're still in the kind of political price discovery process around all of this. We expect that that's going to linger all the way through the balance of the year. Really, you're not going to get a clear read on deficit impact till the fall. Our base case expectation is that deficit relative to current policy is going to be kind of close to where it is right now at the end of the day, mostly an extension of current tax policy.
And it's always a reminder, too. I mean, we're like 7.5 weeks into this administration. So it's going to, to see the ripple effects of this is going to take a lot longer than 7 weeks. It gets to the idea, though, too, about the message that Trump wanted to put out and, how he wanted to spin the narrative so that the American people saw it through his lens. And this gets back to the consumer confidence question. I know he doesn't have a lot of appeal outside of the Republican world, but was there a message there that could potentially maybe sway some of the folks on the other side of the aisle that, yes, there is a long-term economic initiative, a long-term economic plan here that maybe they can get on board with?
Yeah, I don't know. There's such a subjective question in the sense that I tend to favor what the polls are going to say about this. So I think he asked that question again in like 1 week or 2 weeks. Because I've been wrong many, many times in trying to project forward what any political candidate might say and how persuasive that would be. I think this president has been far more persuasive on voters than a lot of experts would have thought. So maybe there's something there. But at the end of the day, I think one message from the election is that voters do care a lot about tangible economic impacts. And so that's probably going to matter more than any message that came out of the State of the Union.
All right, a very diplomatic answer. Not going to expect anything less. Michael Zezas over at Morgan Stanley, a closer look at some of those Washington policies and the effect on the broader economy and the broader markets. When we come back, a focus on tech, a focus on Apple. Apple's shares all over the place today. This after plummeting earlier on the rollout of its updated MacBook Air laptops with AI-ready chips. We're going to explain why in our Stock of the Hour. That's coming up next, right here on The Close. All right, stocks getting the bid here on the day. The Mag 7 doing their part, with the exception of Apple. A flat open and a deep dive lower. They did poke their way back into the green, but now unchanged on the day. This after the tech giant unveiled its latest MacBook Air and Mac Studio with AI-ready chips as it continues its push into the artificial intelligence arena. Jess Menton joins us right now in our arena here in Studio 2. All right, they introduced new products. They got AI in the name. The stock should be rallying on this. What gives?
Right, especially because the M4 chip, we actually already knew because Mark Gurman, who reported this story, he kind of broke this news a few months ago that we should be anticipating that they were going to roll this out in more of their products that you were just mentioning. And even on the earnings call, Tim Cook talked about this at the end of January, about how when you're looking at what's happening with the MacBook sales and things like that, that was offsetting some of the declines we would have seen elsewhere with the slowing iPhone sales. So there was already optimism about this happening, and especially with the AI story and how much they're investing into AI and more broadly in the U.S. as well, because they had talked about they're going to put about $500 billion into investment into the U.S. over the next few years. So really, what's the trigger here and why we've seen this stock still drawn down more than 10% from that December all-time high that it last hit is tied to what's going on with tariffs. So Rana at Bloomberg Intelligence was estimating there could be a 180 basis point hit for 10% tariffs on its operating margins. But if it goes to 20%, that would basically have to double that threshold. So that's why you've seen some more pain here for Apple.
And what are the chances that there be an exception for a company like Apple? Have we read anything on that?
And so that's what Anurag actually put in his notes to his clients today, talking about how that would be the thing that could help this, especially when you're thinking about the outlook for earnings, because we know that Apple is one of these companies, it's always going to have kind of buybacks and announcements that it supports its stock, especially in the beginning of May, actually, of last year. It had announced that historic one of over $100 billion for that buyback announcement program. So that's obviously underlying the support of the stock. But as it gets closer to that 200-day moving average at 226, that's the big thing, because it's unclear whether or not Apple can get that exception.
I just want to bring up another stock, too, because Apple can still move the market. There's a company, SITM. I never heard of this company.
Yes.
SITM is the ticker. It's about a $4 billion market cap, and it makes something called timer chips. Now, apparently somebody did a strip down of the new iPhone 16e or whatever it's called, and they found this company's components inside that, and so you're seeing that stock up like 20% on the day.
It's a massive move.
Yeah.
It's up almost 19% right now, so it'd be its best day since November 7th. It has a market cap around $4 billion. So you're seeing other moves here, even though Apple isn't moving quite as much, obviously, on this chip news when it comes to the M4 and what that could mean for its processors and its computers. But you're seeing other things on the other side of its segments when it comes to the iPhones, like a company like this moving on it.
And, apparently, just so you know, it uses silicon parts to replace traditional quartz oscillators that are used in the iPhone 16e. So I hope that clears that up for you.
Yeah, what did you say?
Totally, exactly.
Okay.
No, fair enough.
Sorry.
That's how that goes.
I was just too focused on that chart, which had the great headline, Return of the Mac here.
Oh, I actually made a comment about that earlier. That's amazing. I love that.
Okay.
Terrell made that chart, and so he's
great. Mark Morris.
It was great.
From back in the day, so, yeah.
Let's
do you want me to sing it for you, Alex?
Yes, I do.
By the way, thank you for being so patriotic today.
You're welcome.
I appreciate your service.
Power suit red.
Yeah,
okay. We are looking at a market here that's doing quite well. You have a Nasdaq up by about 1.5%. Jess, thanks a lot. We really appreciate it. We are about 15 minutes away from the closing bell. Shelby McFaddin, investment analyst with Motley Asset Management, will be joining us. S&P up over 1%, Dow up over 1%, Nasdaq up 1.5%, a big reversal from what we saw yesterday, but volume is still relatively light. This is Bloomberg.
As long as we chug along maybe at potential growth or maybe slightly under potential growth, I think that the mid-cap sectors of the markets actually get the biggest benefit from deregulation and all of these other things. And this is where the boost should actually come.
Jim Caron over at the Morgan Stanley Investment Management kicking us off to the close just about 50 minutes ago. A modest bid coming into small caps and mid caps, a stronger bid into some of those big cap tech names.
Yep, I like what Jim was talking about in terms of the weakness comes now, and that comes in the form of tariffs, but the good stuff comes later. But how long that gap is really a question. And to that point, just take a look at energy, down 1.5%. Oil really getting whacked. If you wind up hurting growth because of tariffs, that's going to sink oil demand.
And it's also interesting, too, when you see the drop in the dollar today, also the moves in the bond market, you have certain pockets of this market that are clearly girding for slower growth. And then, of course, you have whatever this rebound is that we're seeing right now in equities.
That was a perfect way of putting it. Whatever this rebound is, because I don't think we actually know. Like, what happens tomorrow? We have low volume rebound. What does that mean?
The low volume rebound here as we get closer to the closing bells. Just about 9 minutes ago with the gains for the day appear to be holding into those bells. Shelby McFaddin joins us right now, investment analyst at Motley Asset Management. And Shelby, you guys always have a great sense of what's going on in the retail space. And I am curious, what are the vibes right now amongst retail investors?
I think part of the vibes are really wait and see, and it's exactly for the reasons you guys just pointed out. Every day is a little bit different. Now, the volatility that we're seeing right now is, truthfully, even though it feels comparable, it's really not even comparable to some of the worst situations we've seen in the market. And because of that, we have to just sort of sit tight. Now, we can see that some investors are wary of things that have that sort of surface level uncertainty. So there's a lot of folks that are a bit more bearish on the consumer. We've got Costco coming out this week tomorrow. So we're going to get a bellwether of what that's looking like. We know that there's a little bit less appetite for some small caps, even though we're seeing a little bit of forgiveness back when we look at the institutional side.
It's so funny, though. I mean, people make this pitch for small and mid caps, mids, or whatever you want to call it. The idea that, at least on a relative multiple basis, they're at generational lows. I mean, probably some of the lowest we've seen before we were even born. But it gets to the question as to why are they at those lows? And I am curious about, if you can kind of put your economist hat on, this idea of whether we should be concerned about a materially slowing economy, because we had manufacturing data the other day that was awful. Then we had services data this morning that was actually pretty good.
Yeah. I think when we take a look at small caps and we ask why is this continuing to go on, we look at what's happened the past, I guess, 2.5 years in the rate environment, and we think of how small caps finance their growth. Unless you're a family-run business that has pretty much said we're not even taking debt on, chances are you have gotten where you are just top line alone, even before getting to positive earnings, by using some sort of debt. So immediately, expansion got harder for you. So that's one thing. Then you have wanting to look at the retail side of things. Small caps tend to be less liquid. They tend to be most exciting the day before and the day after they report earnings. And then everything settles in. They go up 14% or down 14%. You hear from them again in 3 months. So unless you're willing to accept that risk and have that long-term orientation, they have these situations where in between quarters, they just have either whatever punishment or excitement they've been doled out. And then that tends to really influence the return for the long period. So given the fact that we were out of the sort of free money time period that we were in for a while, I think that hit them harder. I think there could have been a chance that we got out of those sort of multi-generational lows if not for the change in interest rate environment.
Right, and then now you have the tariff risk, and that layers a whole other thing on input costs, et cetera.
Yes.
So if I want to hide out, like what's a stock that I can hide out in that will be insulated from headline risk?
Coincidentally, it's probably one of them would be Costco, and that's in our TMFE ETF. And, you know, we do love the stock. We don't love the valuation, but we just love that company. It's run exceptionally well. They're continuing to get more and more consumers, even in an environment where in the United States, household formation is kind of tepid and people aren't having quite as many kids. But it's not just about all of the sort of perishable items you can get from Costco. You can buy your sweats there. You can buy everything you need to clean your kitchen. You can get your home entertainment center there. People in households of just 2, 3 are finding ways to use the wholesale market to their advantage. And really the money there, the profits are made from the membership. It's something you pay once a year. And for the most part, they're able to capture that upper middle income section of the economy that really puts the most money back into the system, even though it's a fewer number of households. So that is definitely a sort of place where you can park capital. Now, that's not a guarantee that they don't suffer a little bit if we get any sort of correction. But it is a place where there's a pretty reliable dividend. Management is very stable. They've done a great job with their succession planning, so it's not something that we're concerned about there. And it's almost sort of like an upper income comp to Walmart, where they're able to just get, instead of Walmart kind of moving up, Costco has been able to move a little bit down market. And they've sort of got this Venn diagram of households that they're both able to capture, and it's very sticky. It takes a lot for someone to cancel.
My mom, 82, just got a Costco membership.
They're still getting clients.
Jamming. That's what I'm saying. Okay, what else do you like right now?
I would say we're also looking a lot at the payment networks. So Visa is a favorite in one of our passive ETFs, active against the S&P 500, also in our TMFE ETF. And that's because they're a toll taker. I think when we think about the economy potentially slowing down, it still does take a lot for folks to just fully reduce the amount of money they're spending. When you add inflation on top of that, and you think about the toll taker on a nominal basis, they're still going to keep making money. If we drill down and say, okay, what are the real returns? What's the real performance here? Then yeah, you can knock them a few pegs down.
But on that note, I saw you also like Toast, ticker TOST, which I understand, they could kind of be considered a toll taker to a certain extent as well, but they're also much more tied to discretionary spend at the restaurant space.
Yes, and the reason we like Toast, I think, is a great example of active management. So that's in our TMFM in mid-cap. And yes, when you look at discretionary, you say if the belt's going to get a little bit tighter, people are going to spend a bit less. But the rising tide can move all boats, but if your boat has a propeller and the other boats just have an oar, then you can last a little bit longer. And Toast is kind of in that situation where they've picked up a lot of that market share. And if you are a small restaurant and you are taking this leap and you're up and coming, it's one of the first places you're going to go. Being a cash-only institution is not the fastest way to growth at this point. Consumers love that convenience of being able to just tap and go, especially that opening up the tab function. You go ahead and scan a QR code. You've opened up a tab. You can limit the amount of servers you even need in your establishment. So yes, it's something that's going to be exposed to the cycle, but they're likely to fare a bit better because we're now talking about sort of mission critical software as opposed to something that is discretionary to the business that it serves. That's where you start to get a little bit hairier.
All right, got to leave it there, Shelby. Always a great conversation. Shelby McFaddin, investment analyst over at Motley Full Asset Management. Toast having a pretty good day. Alex up about 4% here. I know you eat out. I do want to go back to something you said a little bit earlier. You were actually surprised that Jack Daniels was considered like low end.
I kind of was, yeah.
So what does that say about you?
Nothing good.
Okay.
I don't think.
Okay.
Well, I don't drink hard liquor.
Oh.
I only drink champagne and wine.
Oh, wow.
I know. That sounds so obnoxious. You know, this goes back to my childhood and too much hard alcohol in high school. Anyway.
All right. Well, you walked right into that. Anyway,
did.
stocks holding on to their gains, not far off session highs of the day. A full breakdown of all of today's market action as we head towards those closing bells. A global simulcast starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Alex Champagne-Steele taking you through the closing bell with a global simulcast. Scarlett Fu in the TV studio. Carol Masser, yes, I know you were the queen of wine, but put it aside.
Know more about this. What's up with the champagne?
Tim Senevic alongside Carol Masser.
No, Alex, tell us all.
Oh, no, he was just making fun of me because I don't drink hard alcohol, and I thought Jack Daniels was low end, and then I said, I just drink champagne, and then, hilarity ensued after that moment.
I can only imagine.
Anyway.
Everyone has to introduce themselves with a drink of choice before they begin talking.
There is a market-related one, right? We're talking about, what's the brand?
Brown-Forman.
Brown-Forman, sorry. Yeah, right? They're outperforming. It actually was one of my gainers.
Yeah, they're up 10% today.
Yeah.
So you know what Carol didn't have as her gainers today?
He has been giving me such a hard time. I'm like, don't go Romaine.
All you got to
me.
look at is what automakers are doing. Since Caroline Leavitt confirmed this kind of pause here.
I made it.
General Motors up 7% right now.
Romaine has become a verb.
Ford up 6%. Stellantis
this is only a reprieve for 1 month. Things could change in 3.5 weeks again. And
this is why I love
going through this whole rigmarole again.
I heart you, Scarlett.
Well, I don't really know anymore what we're talking about, so I'm going back to the tariff landscape and that being a short-term issue versus the longer-term positive of, say, tax cuts and deregulation, and how that gap will be bridged. This rally doesn't seem like it has a lot of conviction because volume is so light.
It doesn't. I mean, you are seeing some of the big cap tech names lead the market higher, like Microsoft and Amazon, with big drags today coming out of the oil and gas space, as well as with a lot of the financials as well. Exxon, one of your favorites there, Alex, down 2% on the day. Nevertheless, it is green across the screen. It looked like that market rally was in jeopardy earlier in the session here, but there's been pretty meaningful and steady gains into the close for the past 2.5, 3 hours. The Dow up almost 500 points or 1.1%, and S&P up about 64 points or 1.1%. The NASDAQ composite up about 270 points or 1.5%, and the Russell 2000 adding 21 points or 1% even on the day.
All right, checking out the S&P 500, just digging a level deeper. 376 names in the index are actually higher today. Got 126, Scarlett, to the downside.
All right, let's take a look at the IMAP. Pretty solidly green. There are two sectors in the red. Energy off by 1.5% and utilities losing 0.7%. Definitely the smallest slices of the pie. Materials are the big winners of the day, gaining 2.6%. And consumer discretionary, which houses autos and auto component makers, are up by 1.75%. Industrials also gaining more than 1.5% on the day.
All right, guys, let's get to some of the individual gainers. Check this out. Not a name we talk about a lot. Ticker is HII, Huntington Ingalls Industries. It's a top gainer in the S&P 500. You know, what the president says, we know, can move markets or move stocks. And he talked last night about building up the U.S. shipbuilding industry. Well, as I said, a top gainer, biggest move intraday that it's ever seen in terms of trading. It is a U.S. military shipbuilder. And again, we did see the Wall Street Journal coming out specifically saying that the Trump administration is getting ready for an executive order to bolster U.S. shipbuilders and shrink Chinese dominance in the industry. So definitely a name on the move. MicroStrategy up 12%. Folks, Bitcoin goes up, MicroStrategy goes up. Friday, keep in mind there was a summit of major crypto industry leaders to talk about crypto policy. Fortune noting some comments by U.S. Commerce Secretary Howard Lutnick that seemed to hint that Bitcoin would have a special status with a U.S. crypto reserve. So that's floating out there. Freeport-McMoRan, copper was a big trade, not just the commodity, but the players in the space. This one finishing near its highs. Freeport up more than 9% in today's session. Remember, we did have that speech last night from President Trump, the idea of a 25% tariff on imports of the metal. This is playing out, so better for the domestic players. Keep in mind the president had previously ordered an investigation into copper levies without proposing a tariff rate. So that's floating out there. And then Alex Champagne, Brown-Forman, we talked about this. Yeah. It's up 10% here at the close, maker of Jack Daniels, which is apparently lowbrow. I didn't know that.
They make champagne too. No, Corbel.
Okay, look.
It's sparkling wine.
Corbel does not count as anything real. Okay.
You forgot the automakers on there, too. They had a great day.
Move
having its best day since October.
Move along.
Did you see Stellantis close?
I did.
The most in
Tim,
3 years, with the biggest gain in 3 years
I hate
today?
you both right now.
Yeah, sometimes we got to gang up on you. Hey, CrowdStrike today down 6.3%. They fell after the company issued a worse than expected earnings outlook. This company is still recovering from what happened over the summer, that software update that crashed millions of computers globally last year. Despite disappointing projections, CrowdStrike topped estimates for a couple subscription revenue benchmarks. These are key benchmarks in the fourth quarter. Annual recurring revenue totaling $4.24 billion. I never like talking about energy when Alex is around because she's knows everything about energy, but I got to talk about the energy companies today. ExxonMobil down 2%. Energy names as a whole tumbling today. Tariff uncertainty in Canada and Mexico. OPEC Plus's plans to revive halted production sent crude prices lower. That weighed on shares of the biggest oil and gas names. But Alex, what else do we need to know?
No, you
about
can all be smart.
today?
You can all be smart on energy. But I will tell you, the JP Morgan had a report out earlier today that said that if you have a 100 basis point hit to GDP in the U.S., that could equate to a demand growth hit of 180,000 barrels of oil a day, 70,000 barrels of oil a day in China. So it could wind up being material. Plus, you had a stockpile build in the U.S. today as well. So that's never a good mix.
You are our Renaissance woman. Champagne and oil and energy. Love it, love it.
Okay, no good segue, but Abercrombie
Totally.
and Fitch shares were worth checking out today. They were down double digits, ended up closing down 9.2% today. They hit their lowest level at the close since December of 2023. The company did report weaker than expected fourth quarter sales. For the Abercrombie brand gross margin that trailed Wall Street estimates. Abercrombie did say that tariffs enacted last month were taken into account in its guidance for operating margin.
All right, I'm going to the bond market, guys. It was a pretty much sell the back end of the curve story, but the narrative that seems to be evolving is buy the front end potentially on Fed cuts that now will take place this year and sell the back end because of growth worries. That's what everyone keeps writing about. But today, as we see as it ended, all across the curve, a little bit of a sell-off. Back end yields up by about 3 basis points.
I think what's interesting, can I just throw this out here? I'm just kind of blown away. We haven't talked a lot about it. Maybe you guys did, but what happened in Germany overnight?
Yes.
That incredible spend, that market up 3.4%. The DAX, it's up now, I think something like 16% for the year, just looking at numbers. We just talked with Aaron Kennan of Clear Harbor, and he said there is a little bit of a liquidity shift going on if you look at the outperformance in Europe and elsewhere. So just something to throw out there.
All right, we are getting some earnings crossing the wire, including from Zscaler, the cybersecurity software company, reporting earnings for the most recent quarter. Adjusted EPS coming in at 78 cents a share. That's a beat. The street was looking for 69. Revenue at $647.9 million. That's also a beat on that front. The company saying that for the third quarter, it does see revenue in the range of $665 to $667 million. That's right around what the street was looking for on average. And the company for the full year calculating billings at $3.15 billion to $3.17 billion, also relatively in line with estimates.
All right, let's go to Grindr now. That company also reporting earnings. It has launched a buyback program.
Are these sandwiches? What do they make?
No, not sandwiches.
Nice try.
A different kind of company.
Oh, do tell.
Yeah, dating app. Grindr has
a different kind of sandwich.
Yes, that's right.
Wow.
No.
It's a family show here.
Should I go back to the earnings?
Yep, go.
Let's go back to the earnings. All right.
Yes.
It has approved its first share buyback program of up to $500 million. So that is probably helping limit the losses in the stock right now and after hours trading. It sees 2025 adjusted EBITDA margin above 41%. Analysts were looking for somewhere in the neighborhood of 42.3%. And it sees 2025 revenue of at least 24%. Again, that buyback program probably helping to lift the stock right now.
All right, I'm taking a look at Marvell Technology, guys. That stock is out. In terms of the fourth quarter, they did beat on earnings. They also beat on net revenue for the fourth quarter. Looking at the adjusted guidance for the first quarter, though, looking at 56 to 66 cents per share. That estimate was for about 60 cents. However, Marvell Technology is falling by about 9% post-market. I was taking a look at the press release to see if there's anything on AI, and the only thing so far is talking about their AI silicon programs have now entered volume production, and they do see strong growth from their interconnect products.
All right, Alex, got another one that's falling in the aftermarket. MongoDB, it's down more than 5% here, reporting adjusted earnings per share for the fourth quarter that did beat the average analyst estimate. Adjusted EPS of $1.28 versus 86 cents year over year. The estimate was 66 cents. That seems like quite outperformance, but we'll look for some more color on that. Revenue, $548.4 million. That's up 20% year over year. The estimate was $518.6 million. So that too is a beat. The company also talking about service revenue of $17.4 million, subscription revenue of $531 million. But I'm looking at this one down more than 7% in the after. Some commentary. Our full year guidance assumes non-Atlas revenue, so talking about particular products, will decline high single digits in percentage terms on a year-over-year basis. So we'll look for more on the analyst call there.
All right, I'm looking at shares of Lending Tree. They're higher in the after hours by about 7%. The company's small cap. We do see 2025 revenue coming in at $985 million to $1.03 billion. Estimates are for $1.02 billion. Fourth quarter adjusted EPS coming in above estimates at $1.16. Romain.
I just want to mention Sleep Number, obviously a tiny company. This is, of course, the mattress company that's down like 90% from its all-time high back in 2021. The company reporting earnings, 12% drop in sales in the quarter, but also saying that it has found a new CEO, saying that Linda Findley will take over as CEO on April 7th here as this company really tries to turn things around. A loss per share widening in the most recent quarter as well, 21 cents a share in the most recent quarter.
Yep, Sleep Number right now down about 9.6% here in the aftermarket. All right, guys, that's a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. Alex heading out for some champagne, perhaps. But Scarlett and Romain, of course, continuing there on television. Tim and I continuing right here on Bloomberg Business Week.
A lot more coming up here on the big program, including a look at the impact tariffs could bring to an already stressed out restaurant sector. We're going to talk to a person whose M&A strategy has been so successful at Tony Roma's, she was named the CEO. That's coming up in a bit, right here on The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romain Bostic. That rebound rally that the market was looking for yesterday, they finally got it today here, shrugging off some of those concerns about tariffs. The broader markets did post pretty sizable gains on the day, a 1% jump for the S&P 500, led primarily by big tech. But you did see a lot of strength in the defense and aerospace sector as an index up 2%, the best day since at least early January. Huntington Ingalls, the big gainer in that, largely on the back of comments by the president last night about rebuilding the military shipbuilding infrastructure here. So potential winners there. The Philadelphia Semiconductor Index also rebounding, up for a second day. In fact, 29 of the 30 stocks in that index were up, except for one, and that was Intel, which was down, and that was largely because of some comments that Trump made about rescinding, potentially, the CHIPS Act. Bitcoin also getting a bit of a rebound as well, also because of, well, Scarlett, things that we're hearing out of Washington. That continues to be a big driver of market moves.
Absolutely. Let's continue with the green arrows and talk about Moderna, up 16% on the day. This is the drug maker gaining the most since December of 2022. It expects to launch a personalized cancer vaccine that is developing with Merck in 2027. They're currently in a late-stage trial for a vaccine for skin cancer. And CrowdStrike, the biggest decliner in the NASDAQ 100, losing more than 6% on the day. The cybersecurity company giving a disappointing outlook, a sign that it still hasn't fully recovered from that bad software update that crashed millions of computers last year and led to flight delays around the world. All right, our top story this hour, though, is something that's much bigger picture. It's about an aging population that needs retirement savings to work for it. According to the World Health Organization, the share of the global population that's at least 60 years old is expected to double by 2050, reaching 22%. You combine that with advancements in medicine and science, and it's clear that both lifespans and health spans are increasing. So given this demographic shift, how do we ensure that future generations are economically prepared? Later this hour, we're going to share insights from experts on positioning investment portfolios for the long term. Romain?
All right. Well, another sector, of course, that is struggling to navigate what that long term is going to look like is having to navigate what the short term looks like now. Policies coming out of Washington on tariffs and immigration having an outsized effect on the restaurant industry. We spoke with Mina Hawk a little bit earlier. She's the CEO of the restaurant chain, Tony Roma's.
Location is everything in a restaurant industry. There are some challenges like in shopping malls because people do a lot of online shopping these days. So you don't see as much foot traffic as you would used to back in the days. However, like, standalone locations for Tony Roma's, for example, inside casinos, wherever you would see foot traffic, we see people are still lining up to enjoy our ribs.
Where is your primary footprint right now?
Las Vegas, Nevada. One of our most successful franchisee is in Nevada, although we are based in Florida. Most of our units are franchised units.
So there are trade groups that project that U.S. restaurants could take a massive hit from tariffs, potential tariffs on food from Canada and Mexico. How do restaurants get in front of that or at least mitigate that?
That's a great question. National Restaurant Association have projected there may be a $12 billion hit just only from tariffs from Mexico and Canada alone, the 25% tariff. For restaurant industries, these trade associations have been trying to ask for an exemption. Can the food and beverage industry get an exemption? Because let us feed America. We want to feed the country and we want to make sure we're not affected, because who is affected as a result of tariffs? It's usually consumers. What ends up happening? Your supply is running low or the pricing is going up, or the other option is to innovate. But the cost is so high, even to innovate, that comes with a cost when your bottom line is already suffering as a result of the tariff.
Yeah, I mean, never mind tariffs. You just look at food ingredient prices, right? Egg prices remain high. Beef prices are seen supported by smaller than average cattle herds because of high feed prices as well. What is the new normal for restaurant margins, profit margins now?
Somewhere between 3 to 5% pre-tax. It's one of those industries, it's very cost heavy, very cost heavy. And especially with the supplies, and we don't have that many options, right? Because we have broad line agreements like companies like Cisco and GFS, and there's what I'm thinking as a result of the tariff, people may start thinking about innovating the supply chain. Perhaps we may see some vertical integration where people may be thinking, restaurant owners may be thinking, especially big companies like our brand, may be thinking to create your own supply ecosystem.
How difficult would it be to do that? I mean, obviously a smaller independent restaurant is going to have the option to do that. But for a chain or a franchise situation, do you have more power, that flexibility to do that?
It's easier said than done, frankly speaking, because the reason we turn to big broadliners is because they have a network of distributors and the logistical ease that we get, having contracts with companies like Cisco. However, if anyone's trying to innovate in this space, it will take a while, and it depends on how capitalized you are as a company.
How much pricing power, though, do you have? I mean, can you pass some of those costs on? I mean, if you have an entree that's on the menu for $20, if you raise it to 22, are you actually going to lose revenue because people stop ordering?
Yeah, because what we have seen in the past, when you increase the price, there is an immediate decline in the demand. And the other point is what we spoke earlier about location. It depends on where you're located. Right. If you're located, in a place like an airport or next to an arena, then that's different. You're already generating a lot of foot traffic, but for most of the food establishments are not.
Right.
You also run a law firm that specializes on immigration law, in immigration law. Is the White House's crackdown on undocumented immigrants creating a labor shortage for the industry at large? I'm wondering what a restaurant company can do, what steps it can take to protect the workers that it does have to ensure that it can continue with its operations.
Yes, there have been a lot of changes in the immigration front, especially, for the restaurant industry that relies heavily on immigrant workers. There is a lot of trepidation right now, a lot of apprehensiveness where people are just scared. And I think we need to change the narrative about that. There are companies, that hire legal workers, and we're talking about legal workers, and they should be allowed to work in this country because our industry is so heavily dependent on them. And as a result of all the changes that we are seeing, it is very hard to hire.
And that was Mina Hawk, the CEO of Tony Roma's, the rib restaurant. We just want to jump in here and give you an update here on Victoria's Secret. The shares are higher by about 1.5% in after-hours trade. Fourth quarter adjusted EPS and net sales did top analyst estimates, but the outlook for this quarter is a miss. The first quarter net sales, it sees a maximum of $1.33 billion. Analysts were looking for $1.39 billion. And for full year net sales, it sees at most $6.3 billion. Analysts were looking for $6.34 billion on average. So the stock bouncing around here, but just modestly higher at the moment.
All right, let's go back to the restaurant space here because tariffs and possible labor shortages top of mind for our next guest, who's more in the luxury hospitality space. You've heard of Major Food Group, the company behind restaurants like Carbone and Contessa, Dirty French, and quite a few others. Pleased to say that the co-founder of Major Food Group joins us right now, Jeff Zalaznick, Jeff. And, you know, you guys are, I feel like, kind of have a slightly different clientele than maybe what we see at Tony Roma's, a clientele with a lot more money to spend, and obviously really indicative of that is the presence that you've had at these F1 races that have been taking place in Miami for the last couple of years. It's coming up again in May. $3,000 just to get in, $40,000 just to get a seat at the table. Jeff, it seems like business is doing pretty well.
Yeah, thank you, Romain. I mean, I think that, you know, we're really excited that this, you know, we just announced that for the fourth year, we're going to be throwing Carbone Beach for Miami Race Week, which is an incredible event we throw on the beach in partnership with American Express. And we're thrilled to be bringing it back. But at the end of the day, I mean, you know, that's just another indicator for us, you know, how strong the luxury segment has been for us. You know, it's an incredible over-the-top luxury event like you'll find at no other, you know, event that occurs around the country that we put on, you know, an incredible, super over-the-top dinner party with entertainment, you know, 3 nights in a row around the race, May 2nd to 4th. And we're thrilled to be coming back and doing it again. We're going bigger, we're going better, you know, we're charging more. And I think that, you know, all indicators to us show that, you know, customers want an incredible experience and they are willing to pay in the luxury segment for something if you deliver on that experience and you continually, you know, create confidence with your consumers that if they are looking for a experience at the highest level, they can trust us and they know they'll come to us and then we're going to provide it. And I think that's what's been so successful for Major Food Group.
And I'm curious too on that front too. I mean, we talk about the price tag and obviously you're getting a lot more for 40 grand than just a meal. But there's this idea, Jeff, that, I mean, let's just kind of go down the income spectrum, if you will. Even sort of, you know, non-wealthy consumers are also looking for experiences. If anything, probably more so because they're really trying to justify the cost of spending, you know, a couple $100 to go out and hang out with their friends here. So how do you sort of approach that segment of the population that also wants to partake?
I mean, I think, listen, at the end of the day, it's a supply and demand thing. At this point, you know, what we put out and what we spend and the effort and the money and the costs that are associated with putting on this giant event where we recreate and build from scratch an enormous, beautiful tent on the beach, you know, and then put on, again, a spectacular dinner party with, you know, incredible entertainers every evening, you know, is a specialized product, right? And that's really look for someone that is willing to spend the, you know, $3,000-$4,000 it costs per seat, per ticket, that to come to this kind of event. And that's what that's the luxury segment. So that's what we're focused on. That's where this event really is. The if you're looking for something, you know, at a different price range, that's really not what we specialize in, nor is it what Carbone Beach offers. Carbone Beach offers the most luxurious, you know, dinner party experience that you can have at any sort of event. And, you know, the one in Miami's become quite iconic at this point in time.
And that's why people are willing to pay up for it, Jeff. But I wonder, costs are going up. How do you manage through that? How much of that gets passed on, or do you kind of decide on a price ahead of time? And if your costs are going up after setting your price for the tickets, you'll just kind of have to eat that.
Yeah, well, I think in general, you know, we're always taking into consideration, obviously, costs that are going up and then pricing things accordingly. I think that, you know, there's a little bit less sensitivity in the luxury segment than there is elsewhere. And so, you know, we have the ability, obviously, to adjust pricing, you know, as costs increase. And not see it have an effect on our business because it raised, you know, passing that cost along to the customer, is not an issue really as much in luxury, right? People want you to deliver. And I think that that's what we focus on, which is delivering the best experience, the best product, the best food, the best service. And as long as you do that, everyone is happy.
Okay, so they want you to deliver. Has it been difficult to recruit the right talent to staff your events, to staff your restaurants, to staff your clubs? Because that is of major concern, and particularly in big cities that do attract a lot of immigrants.
Yeah, I mean, listen, staffing has always been, one of the difficulties in the restaurant business and hospitality business because it's such a people-intensive business. But again, at the end of the day, we're very fortunate that we've had, many of our people have been with us for over a decade, and I think that, we have an incredible team that continues to grow, and we also are able to attract talent that wants to work in our industry because we do have an incredible amount of growth, and we're constantly opening new things. We're constantly doing exciting things like Carbone Beach that provide opportunities for people to grow and create a career in the hospitality business. So we do get a good stream of people coming through and are not as affected as some others by it.
I am curious, though, Jeff, about just your general approach to building out Major Food Group. I mean, you have all of these restaurants under your umbrella, and each kind of have their own distinct identity. And that's a little bit different than maybe what some other restaurateurs would do, where you try to kind of keep everything under the same name, if you will. Why did you take that approach? Why did it work for you?
I think we wanted to create lots of different, luxury dining experiences. And whether it's Carbone or Sedel's or Contessa or Teresi or Dirty French, all these that you have up there, they all tell their own story. They all have their own identity, but they all share the same Major Food Group ethos, which, really revolves around storytelling and excellence in hospitality, excellence in food, foremost, and in service. And I think that, the goal was not to we never wanted to create a chain. We wanted to be able to create, different experiences with different cuisines and different stories that we can then, spread across different cities. And, we've now gone from New York to Miami to Dallas to internationally to the Middle East and to Europe, et cetera, with these concepts. And, we find it much more, attractive to do so with a large amount of content versus one single product.
All right, Jeff, going to have to leave it there. Really appreciate you taking time for us, and we got to get you back on around May when the big F1 race in Carbone Beach debuted down there in Miami. Jeff Zelaznik, co-founder of the Major Food Group. Scarlett, you going to pony up $3 to $4 grand just to get in the door? If you want a table, it's about 10 times that.
Maybe in a couple of years I can do that. Yeah, not this year though. Have you been to an F1 race?
No. I mean, I've been to Indy races, but a little bit different than F1. Obviously, Indy they just kind of stick to the oval track, but so yeah.
Well, I mean, Miami has kind of become the new home of all of this, right? Especially, some of the people who have been going to Carbone Beach over the years, real intersection of the entertainment world, the sports world, and of course, finance.
Yeah, and of course, in F1, just overall, globally, has always been an elite sport, if you will, here. And so Carbone, obviously, a perfect fit for that. In the meantime, we're going to continue the show, and we're going to talk a little bit, I guess, more about regular folks here. We're going to talk about retirement savings. Ed Murphy, the CEO of Empower, stopping by the big program to talk about the dramatic growth that he's been seeing in retirement savings. That's coming up next, right here on The Close on Bloomberg.
We cannot close this retirement gap without private-public partnership. We have to have good policy, and we have to make sure that we in the private sector are doing our part to educate our employees, to make sure that the plans are designed so that people can have access no matter where they are within their employee base.
To Sunda Brown Duckett. She's the CEO over at TIAA. A conversation a little bit earlier today about retirement planning with David Gura down at the Bloomberg Invest Conference, which wraps up today in Lower Manhattan. It was a big talk of the conference today, including a panel I hosted, as a lot of people look at the market disruptions and ask themselves questions here about whether you actually need to make changes to allocations so early into this process. Ed Murphy joins us right now, who knows a thing or two about the retirement process. He's the president and CEO of Empower, the second largest retirement services company in the U.S. Ed, great to have you here on the program.
Good to be here. Thank you.
And this is, of course, that time of year where I get phone calls from all of my relatives asking, should I start selling or should I start buying this, blah, 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 because they see all the headlines out there and they start to get worried about a retirement account that a lot of them probably haven't even looked at in over a year. So I am curious as to sort of what is sort of the ebb and flow of participation in these accounts, withdrawals, increased allocations when we get these types of market disruptions?
It's a great question. If you look at the market, particularly over the last 3 or 4 weeks, we've seen a lot of volatility and a lot of uncertainty. The market doesn't like uncertainty. I think lots of concerns about tariffs. But if you look at the typical 401k investor, and we have 19 million investors with Empower, for the most part, they tend to stay the course. I will say, though, over the last 6 weeks or so, we've seen a little bit of a flight to quality where people are starting to move money out of active funds and index funds into stable value or cash type vehicles. But for the most part, I think the industry has done a really good job, and the media, in conditioning people to think about this as a long-term investment. And the other thing to consider is when the market goes down, if you're saving through payroll deduction, you're getting the benefit of dollar cost averaging into lower markets. So I think for the most part, people tend to think about this long term and they stay the course.
I'm curious, what has been kind of the uptake of 401k adoption, IRA adoption, just retirement plan adoption overall? Because we talk about the millions of Americans on it, but we should point out the majority of Americans don't actually have access to these programs.
Well, I have a kind of a slightly different point of view. I think this has been arguably the most successful public-private partnership, or one of the most successful in our country. We have 125 million Americans in the system. If you look at IRAs and 401ks together, it's $42 trillion that's been saved. And obviously we have more work to do. Where we have some exposure, and the coverage gap or the access issue that you hear about oftentimes is typically with companies with less than 10 employees. But I think Congress and the regulators have done a really good job, along with the private sector, to create the kinds of incentives to get small businesses to offer plans, tax credits to set up these plans, and in some cases, the state auto IRA plans, which are mandated plans, 16 states have adopted that, I think have been a good savings vehicle as well. So I'm actually pretty sanguine about the defined contribution market and the private savings market. I think we can do better. But we've accomplished a lot in the last 40 years.
And just full disclosure, by the way, Empower services Bloomberg employees, so our 401k remains 401k is with Empower. So we should just make that clear. But Ed,
You're doing a fine job, by the way.
Thank you, Romaine.
The last time I went on the Empower website was to check my allocations, and I'm curious how many people try to actively figure out their own allocations versus consult a robo-advisor or actually use a professional, because that's a big question. When times get kind of, rough and the markets go a little bit haywire, there's this temptation to make a change, even though, as you said, we've been conditioned to know that this is for the long term.
Yeah, that's a great question. So about 60 to 70% of the assets tend to flow into target date funds. And so that's sort of a set it and forget it type model. And then increasingly, we see individuals wanting to enroll in advice-based solutions or advice-based offerings like managed accounts. And you have an automatic rebalancing that's occurring. You have actually access to someone, an advisor that you can talk to if you want to have conversations. So for the most part, we don't see a lot of tinkering where people are effectively trying to do it themselves. They really turn it over to professional management, and you see that continuity and that stability. I think the biggest challenge for us is to drive higher levels of engagement. It sounds like you guys engage from time to time on the app or with the web or perhaps talking to somebody live. But what we know is if we can drive higher levels of engagement, people just save more. And if you think about the goal and the objective, it's to replace the income that you made while working. So we need to do better in that regard.
And of course, helping to drive that engagement is when companies match your contributions as well. Can you give us a sense of how that's grown over time? Employers matching contributions from employees?
Matching contributions have been significant. I mean, over 65% of the companies are providing some kind of a match. The other thing that we've seen is higher adoption of auto escalation. So every year, an individual automatically sees a 1% increase in their savings rate, in their deferral rate. And what we found is inertia is a powerful vehicle. 95% of the people stay with the increased deferral rate. Only 5% opt out. So we encourage more and more companies to adopt automatic escalation.
All right, good stuff. Ed, really appreciate your joining us today. Fantastic to get your take. Ed Murphy is president and CEO of Empower, which, again, full disclosure, does manage Bloomberg's 401k accounts. All right, as Romaine mentioned, we're at Bloomberg Invest today, and we had a lot of conversations. And I actually spoke with Holly McDonald, Bessemer Trust CIO, Chris Hyzy, the Bank of America Private Bank and Merrill CIO, and Jimmy Chang, who's the CIO of Rockefeller Global Family Office, also about how to position your portfolio for the long term at a time when U.S. stocks, at least for 2025, have been underperforming. Take a listen. So far in 2025, the U.S. assets are kind of falling behind the rest of the world, right? European stocks were near record highs. They've come off of those levels. U.S. stocks have been underperforming relative to the rest of the world by the most since, I believe, 1994, according to Bloomberg Intelligence. That being the case, how do you position your portfolio? I mean, not just globally, right, U.S. versus rest of the world, even when you look across asset classes, the 60-40 portfolio, is it still relevant? Is it dead on arrival? What's your take on that? Holly, let me start with you.
Yeah, I'd say it's not dead on arrival, but it's certainly worth some adjustments, particularly as we're thinking about coming off of the last panel and longevity, people needing to have higher income and returning portfolios over longer periods of time. From my view, that 40 is probably too high in most cases. It should maybe more be like a 70-30 portfolio, an 80-20 portfolio. And then I'd say within that, what is making up the equity risk is very important. Having a sufficient amount of capital in private markets, where in our case, we've been able to compound in excess of public markets, we think is quite important. And I'd say even on the fixed income side, evaluating other strategies that can be higher income earning, perhaps you give up a little bit of liquidity, but if you're looking over a 20, 30-year time frame, that's well worth the trade.
Chris, every time bond yields rise and it looks like there's correlation between stocks and bonds, and this happened plenty of times, this debate comes up.
Well, I think if you look back over 30 plus years, you had downward trending interest rates. We all know the reason why. That created a total return aspect of what fixed income was. And you mix that with equities, whoever created the notion 60-40 probably should have reset it as interest rates were coming down. And once we reached zero, to Holly's point, you were probably something like 95.5 because there was no way for you to meet any kind of goal with a 0% handle. And now you're back to where we were in the 1990s again, 4 to 5% interest rates across the curve. So you're back to 60-40, 70-30 in those. And then how do you actually create within that allocation mix the right different streams given per unit of risk? And there's a number of different asset classes now that will allow you to do that. So from our standpoint what is your goal? What is the role that each of those investments is going to play within that portfolio? And then ultimately use rebalancing. When volatility hits like it did yesterday, be ready. You mentioned cash before, real quick. Cash should be there ready. And if you're going to use cash as an investment, that should be short-term fixed income.
Okay, so what, 6 month, 2 year?
Yeah, below a year or so. Because you're going to replenish, if you know you're going to replenish your cash flow, then going out to a year to pick up a little bit more yield makes sense.
Okay. Jimmy, the holy grail in all of this is looking for uncorrelated assets, things that don't move with the S&P 500, for instance. And Holly had mentioned private assets. Where do you fit in things like crypto, which she says she's avoiding right now, VC, which gives you access to new technology, to AI, for instance, physical assets like real estate or commodities?
Well, I would say all of the above, right?
Do you take it out of the 40? Do you take it out of the 60?
It's really, so to me, 60-40 means to have a diversified portfolio. And then tactically, you can make the adjustments. So we had this, as Chris said, this 30-40 year wave with downward earning, interest rate trends. So you can stay with fixed income. But now I think we're in a new era where rates will be kind of range bound with some catalysts driving it potentially even higher. So that 40 portion, you probably want to look at having some additional alternatives, private debt, for example, And on the equity side, depending on where we're in the business cycle, private equity could also make sense, given that you have new administration that's probably going to be more friendly, approving M&A, transactions that can help private equity. But at the same time, you're also facing higher interest rate, higher funding costs, which is a headwind to private equity. So I would say don't rule anything out. Try to stay nimble. And 60-40 really means to be diversified.
And that was an excerpt of my conversation with Holly MacDonald of Bessemer Trust, Chris Hyzy of Bank of America Private Bank, and Jimmy Chang, CIO of Rockefeller Global Family Office. What was interesting, Romaine, was when we talked about private assets, Chris made the point that there's a big obstacle to people embracing investing in private assets, and that mainly is the S&P 500's incredible run over the past 2 years. Why go into private assets when the S&P 500 has returned plenty for you?
Yeah, well, actually, I might have a retort for you on that here. We're actually going to play a clip from a panel that I was on.
Okay.
So where actually some of the fund managers there talked about the outperformance, the expected outperformance of private assets relative to public markets here. So the idea here that there is a little bit more of a premium there, right, assuming you get your money back, your actual cash out of it. But the idea here is that on a percentage basis here, in their view, not my view, their view,
right,
they see that as outperforming down the road.
All right, well, let's take a look at what happened today, because a bit of outperformance certainly for S&P 500 by the end of the day. We started off lower and we closed at higher by 1.1%, really driven by the auto companies and auto parts after Bloomberg reported the White House is considering delaying by 1 month auto tariffs on Canada and Mexico. You saw the rally in treasuries continue as well.
So is this like a 1 month rally? I mean, because it's not over, right? I mean,
it's
basically it's just 1 month reprieve.
It's relief for today.
Okay, so maybe it gives investors some opening that okay, maybe there can be some compromise. Maybe this could be permanent.
Yeah, well, I mean, again, it's a knee-jerk reaction. We'll see what actually happens because we haven't actually heard an announcement from the White House yet. The other big thing to keep in mind, Romaine, was what happened in Germany. The yield on the 10-year Bund jumping 30 basis points. Yeah. It's unreal.
Yeah, unreal. And in some of these market moves that we're seeing, again, it comes down to the whole issue of volatility, right? It's not about the absolute price levels or even the absolute change. It's those fluctuations that get us there.
This is The Close on Bloomberg.
The Bloomberg Invest Conference wrapping up today in Manhattan, and a big talk across all of those panels was really about the returns that you're getting in public markets relative to private. State of Wisconsin Investment Board's Anne-Marie Fink says that private equity is outperforming expectations, but a little bit of a tension there, saying that the interest between firms and clients still needs to be aligned. Fink, along with Yup Kim, who runs Texas Municipal Retirement System, as well as the New York City Retirement System head Stephen Meier, they all spoke to me on that panel, and they all had some really interesting ideas about where those returns go.
We're believers in private equity, and we like it, and we do think it will continue to outperform public equity over the next 10 to 15 years. That said, the next 10 to 15 years, I don't think are going to be as good as the last 10 to 15 years in private equity, right? We've had multiples go up. We've had cost of debt come down. So you've had these huge tailwinds that really benefited private equity. And so the gross returns were really good, and then we were maybe a little less discerning on how much of that gross to net we got. As we go forward, if I'm correct that multiples won't go up, like I bought it at 10 times, I sold it at 15. If that goes away, I have to buy it at 15 and fix it and then sell it at 15. If that goes away and then also the cost of capital goes away, the gross return is going to be lower. And so again, we want all of our managers to get very wealthy, but only if we're getting the returns for our beneficiaries. So as long as we're aligning those interests, we are happy to work on it. But I think going forward, we are going to all be more discerning about the fees that we're paying.
You're nodding your head. Private outperforms public with an asterisk.
Yes.
Yeah.
And also we've had, incredible return in U.S., particularly large cap equities since the global financial crisis. So that U.S. exceptionalism really is driven by, You could call it mega cap exceptionalism or large cap tech exceptionalism. I don't know that that continues. I think if you look at the next 10 years, the average return is probably high to mid single digits for public equity. I do think you'll see a rebound in private equity. I also think private equity, and we shouldn't say this, but I think it's a better business model. It's a better alignment of incentives. It's longer term looking. There's a lower reporting requirement. It just seems like a better way to generate alpha over time. Again, I think to Yip's point earlier, though, you have to be very selective in terms of the managers you pick. You really want to pick those that have a demonstrated ability to drive value creation, not simply buying something and hoping for a multiple expansion, but those that are more strategic or can impose efficiencies into their companies.
Yeah, and I do think just the quality of beta going forward might have headwinds, but I do think the opportunity for alpha in the next 12 to 18 months is tremendous, right? I do think we have to kind of take a deep breath, right, with a lot of this macroeconomic volatility, and just remind ourselves that we've partnered with world-class investors who will make good decisions on M&A, on supply chain management, on all these things, because the administration's kind of go forward policies will have very asymmetric implications on tech versus healthcare versus consumer, industrials, financial services, business services. And so to the astute and skilled investor, who we're partnered with, who can make the right calls, I think there is outsized alpha to be had in this environment.
Now, for all three of you, obviously the returns you're trying to generate, of course, are also going to be sensitive to inflation. Inflation expectations have started to come up over the last couple of months, primarily because of some of those policies out of Washington. Yeah. Have you made any adjustments yet in your models? Is it too early?
We haven't made any adjustments, though we do have about 18% in tips. So we've been long believers in the inflation protection that we get through that. In addition, you get some inflation protection through some of the equity. If companies can pass through the inflation, you also get it through equity, both public and private. So we haven't done anything specific, but we do feel like we're reasonably protected.
And we just want to thank again that entire panel there. Anne-Marie Fink, the Chief Investment Officer for the State of Wisconsin Investment Board. Yup Kim, the CIO for the Texas Municipal Retirement System. And Stephen Meier, the CIO for the New York City Retirement System. So great conversation down at Bloomberg Invest today.
Yeah, it's a conversation we'll be continuing to have over the months to come. In the meantime, I want to go now to the top three, where we name drop some of the people driving the day's most talked about stories. And first up is Larry Fink. Now, after hearing President Trump's vow to seize the Panama Canal, Fink, who's the CEO of BlackRock, got on the phone to pitch the White House on a deal to buy the ports on either side of the waterway. And it turns out a consortium led by BlackRock is buying control of the ports. Trump actually referenced this deal in his address to Congress yesterday.
Yeah, it was kind of interesting. I thought this was a fascinating story that Bloomberg wrote. A couple other sources picked it up, and the idea this has been in the works. And it wasn't just Larry Fink, but you had Abayo Ogunlesi, whose GIP is now under BlackRock here. But the idea that they kind of corralled these investors, U.S.-based investors, and said, look, let's try to do something. Obviously, Trump wanted to see this in U.S. hands, and this was kind of a backdoor way of doing it, sort of do it through, the financial world rather than the military world.
And Larry Fink ensured that from now on, when he calls, the White House will definitely pick up the phone.
I'm keeping an eye on Brian Niccol. He is a relatively new CEO at Starbucks, and he just had an interesting internal forum with employees, and it was a bit of a tough message here, basically saying, look, yeah, I know we've had layoffs. I know things have been tough. But get back in the office and let's do this thing here. Some of the language I thought was kind of interesting. Obviously, you have a CEO who's come in and basically said, look, there are a lot of things we just need to change and a lot of things we need to do better. And I need your help to do those things better. Of course, some of the employees pushing back and saying that, look, morale's low. You're making all these changes and a lot of us don't quite know where we fit in.
Right. And so it was a tough love, as you put it. It was about making leaders more accountable for not just operational improvements, but financial improvements. He did say, though, that U.S. stores are starting to improve through some of the measures that they've taken, like bringing back self-service condiment bars. Yeah. So you don't have to go ask for a packet of sugar anymore. That was so weird.
I don't go to Starbucks often, but I went last summer, and that was the first time I noticed that you have to ask for.
Yeah, you have to interrupt the guy while he's making the drink.
I felt like Oliver Twist or something. I was like, can I have some sugar,
please? Yes. Well, that and ceramic cups have made a comeback at Starbucks to make it feel more homey and more welcoming.
Ceramic cups?
Yeah, more hospitable. All right, finally, the third person we're watching is Ev Williams. He is the co-founder of Twitter. He's building another social network. It's called Motley or Mosey, I'm not sure how to pronounce it, and it's private.
Yeah.
So that means no public profiles, no follower accounts, and what it's meant to do is encourage more in-person meetups.
In-person meetups, really? Where, like in Temecula? I thought this is an interesting concept, right? First of all, this guy's basically started 3 different social media platforms. He did Blogger, Twitter, and there was another one I'm forgetting that he did. Oh, Medium as well, also, which is technically social media as well. I kind of like this concept. I mean, I think the old model of social media, at least for me, is dead, Scarlett. It's dead. So maybe try something new. Try something different.
Yeah, well, what this does is basically use your contacts and alert other people in your contacts when you're in the same city. So it will say, like, hey, Romaine, Scarlett's in the city right now. Do you want to try to meet up with the person?
I don't know if I like the sound of that. I don't
well,
want
it's
you
because you don't want to meet up with me. That's why.
Okay, all right. We're going to set you up for what's happening in the next 24 hours. This is Bloomberg. Here's what markets are going to have their eyes on over the next 24 hours. It starts with the rate meeting over in Europe.
Yeah, rate cut is pretty much 100% priced in, but the EU is going to hold an emergency summit on Ukraine military aid, and we know that plans to spend have already scared people in the German bond market.
Back here in the U.S., we get earnings out of Kroger, Macy's, and Burlington. That comes before the bell. Also some economic data as well.
Yeah, trade balance and wholesale inventories. How many companies were hoarding the orders before the start of tariffs?
After the bell, we're going to get HPE, Broadcom, Gap, and Costco as some of the names to watch on the earnings front. And for Fed Speak, U.S. Fed Speak, Raphael Bostic of the Atlanta Fed scheduled to speak. This is Bloomberg.